All right, let's get right into it. Today, we're going to break down a professional framework for timing a stock investment. Now, I have to be crystal clear. This is not financial advice. We're not telling you to buy or sell anything. Instead, we're using a huge, well-known company, Exxon Mobil, as our case study. Why? Because it's the perfect way to learn the disciplined, multi-layered method that the pros use to make their calls.
So let's start with the conclusion right up front. Here's the professional verdict. As of late November 2025, ExxonMobil, well, it just doesn't meet all the ideal criteria for a confident buy. It's not hitting the marks you'd want to see for a position with real winning potential.
Okay, so that's the final call. But the real question is, how do you get there? How does an analyst look at a giant like Exxon and say, not right now? Well, that's exactly what we're going to unpack. We're going to peel back the layers of evidence, the price action, the company's health, and what the experts are doing to show you how this case gets built, piece by piece. All right, first things first, the very first layer of any professional analysis has to be the price itself. I mean, what is the stock's trend actually telling us? We need a way to cut through all that daily noise and see what the real underlying momentum looks like.
And the tool for that job is something called the momentum cascade. Now, think of it like this. It's like having 3 different camera lenses to look at the stock's price. You've got your short-term lens, that's the 4-week view. Then there's the quarterly lens, the 12-week trend. And finally, the big picture, half-year lens at 24 weeks. The secret here isn't looking at any one of these lines by itself. Nope, the magic is in seeing how they all move together.
And, well, this chart right here shows you the problem perfectly. See, in a perfect world, a super strong buy signal looks clean. All 3 of those lines, short, medium, and long-term, are moving up together in sync, like a squadron of jets. But what do we see here for Exxon? It's kind of a tangled mess, isn't it? The lines are crossing, pointing in different directions. This isn't harmony, this is conflict. It screams uncertainty, not a powerful, confident trend. Okay, but price action is only part of the story, right? Now we've got to pop the hood and look at the engine of the company itself, and that means earnings. We need to know, is the company's actual performance backing up the stock price, or is there some kind of disconnect going on? So let's start with what's called trailing earnings per share, or EPS. Basically, how much profit the company is making per share. You can see that after a really strong peak back in early 2023, Exxon's earnings have, well, they've started to drift downward. It's not a cliff dive or anything, but it's a gentle, noticeable slide. And look, even though the numbers are still healthy, any kind of declining trend is something you absolutely have to pay attention to. Now, this next chart gives us some really important context. The red line, that's Exxon's earnings. And we're comparing it to the broader market, the S&P 500 in blue, and its own energy sector peers in green. For a good while there, you can see Exxon was crushing it, outperforming the others. But, and this is the key part, look all the way over to the right side of the chart. See how that gap is closing? Its relative strength, its earnings power is softening. And for an investor looking for a leader, that's a bit of a red flag. So, hold on a second. If earnings are drifting down, what do you think is happening with its valuation? You'd think it's getting cheaper, right? Well, take a look. This chart shows the price to earnings ratio. And it's actually been climbing. That means investors are paying more for every dollar of earnings than they were before. And that's the disconnect we were talking about. The stock is getting more expensive at the same time its earnings performance is getting a little weaker. The whole, hey, it's a bargain argument, that's getting a lot harder to make. Okay, let's add one more layer here. Same idea, but now we're comparing Exxon's valuation, that's the red line again, to the S&P 500 and the rest of the energy sector. Now, sure, it's still cheaper than the overall market, but look at how it's starting to merge with the energy sector average. That gap is shrinking. And when that valuation advantage shrinks without stronger earnings to back it up, that's a big warning sign. It's basically telling you the stock is losing its competitive value edge against its direct rivals. So, we've looked at the price action, we've looked under the hood at the fundamentals. The final check, the last layer of confirmation, is to follow the smart money. What are the professional analysts and, more importantly, the ultimate insiders, the company's own top executives, doing? Are their actions backing up a buy story, or are they telling us something else entirely? And this slide, well, it makes things brutally clear. On one hand, you have the analyst ratings. An optimal signal from a well-known service like Zacks would be a strong buy, or at least a buy. What's Exxon's current rank? A lukewarm hold. But even more telling is the insider activity. You know what you want to see? You want to see executives putting their own money on the line, buying up shares. But instead, we see zero insider buying this year. Zero. Just selling. When the people who know the company from the inside out aren't buying, that is a massive caution flag.
So let's put it all together. You've got mixed up momentum, you've got fundamentals that are softening a bit, and you have a lack of confirmation from the experts and insiders. Now you can see exactly how we got to that initial conclusion. But here's the thing. A good framework isn't just about knowing when to say no. It's about knowing exactly what signals to watch for so you know when to say yes. It's about creating a playbook for the patient investor.
And here is that playbook. This is your checklist. There are 4 specific conditions that would need to change to signal a much better entry point. Number 1, that momentum cascade needs to untangle itself and all 3 lines need to point up together. Number 2, we need to see that analyst rating get upgraded to a buy or strong buy. 3, the insider activity needs to do a 180. We need to see executives start buying their own stock again. And finally, number 4, that earnings trend needs to stop drifting down, stabilize, and ideally start outperforming its peers again.
And that is the power of using a professional framework. It takes emotion, guesswork, and hype right out of the equation. It replaces all that with a clear, evidence-based process. Look, the data we looked at today for Exxon, it's going to change. The real lesson here isn't about this one company on this one day. It's about giving you the tools to analyze the data for yourself, whatever the stock, whenever you look at it. So now that you have the framework, the real question is, what are these indicators going to tell you 6 months from now?